Hey everybody, and welcome to week 3 of class. We're just going right through it. Like I promised, it's going very quickly. We have, well, we're 25% done, so we are moving right along. Okay, so last week, as you'll recall, we just started getting into the text a little bit more. We talked about accounting, we talked about you learned a little bit about financial analysis in the form of ratios. You learned about financial forecasting and some of the ways you can go about doing that. We talked about the concept of operating and leverage in general, and looking at it specifically, breaking it down into operating and financial forms of leverage. And then in chapter 6, we introduced the idea of working capital management, which we'll expand upon this week. Um, so that's what we did. And again, if you have any questions as you go through any of this stuff, don't hesitate to reach out to me. Just send me an email, or if you want to talk directly, send me an email with 3 times you can meet in a in a video meeting application. Um, uh, I think I found out last week when doing one-on-one meetings that using Google Meets is probably the easiest thing to do, and so we'll probably end up using that to actually set up a video meeting with me. Okay, so let's talk about what else we're going to look at. Okay, a couple things coming up this week. A really big one is your first unit test is coming up, is due this Friday. I'm going to put out a separate video on that early this week. So kind of give you an overview of it, but plan on that. You want to have gone through and really understood chapters through chapter. Uh, Let me think. I want to say chapters through chapter 8. Okay, so that's what's on. Chapters 1 through 8 is what's on the test. So be prepared for that. Best way to prepare for it is to kind of go over the homework and review some of the concepts that you read, because the test itself covers conceptual things, concepts that come in the form of multiple choice questions, and you also look at things that are very similar to the work assignments you've been doing in the homework. Okay. So my best suggestion is to go through all those things before you attempt to take the test. That's as good a way for it as possible. Okay, so let's talk about and then one other thing I wanted to mention about it is, if you've not taken the first test, the test number 1, you have to do that. It's a requirement to even attempt to take test number 2. So make sure you've completed test number 1. That's a very important step that you do. And that'll entails signing up for Honor Lock. Okay, so you'll just get all that stuff taken care of, so you don't have to mess around with it when you actually sit down and take the test. Okay, so let's talk about what we want to talk about this week. We're going to continue with the concept of working capital management. Even chapter 7 is next. Chapter 7 and 8. You want to get that done and the homework done by tomorrow night. We'll talk about current asset management. Basically, involves managing cash, marketable securities, accounts receivable, and inventory, all current assets. So what's involved with cash management, believe it or not, investors don't look kindly on companies that have too much cash on hand. And you think it's like, wow, what's the big deal? That cash is a good thing, isn't it? It is, except you can take your own cash as an investor and invest it into a bank account or something like that and get some interest rate. You don't have to give it to a company to do that for you. You expect them to do things with the capital they raise from you. So not put it into a bank account, right? So cash management is an important thing. Talk about management of marketable securities, especially larger companies usually have quite a portfolio of those. Accounts receivable management. Most companies have accounts receivables, especially if they're selling to other businesses. You always have to sell people on credit terms. So accounts receivable is an important thing to manage. And inventory is a real big one. For a lot of companies, it's their largest asset of all, of any. And you can see where retailers have a lot of dollars tied up in inventory and that type of thing. So, interestingly enough, inventory has become a very tightly managed asset, which requires really effective forecasting and the ability to tie that to production. So we've developed ways of doing that very efficiently, almost too efficiently. If some of you may recall during COVID, um, not being able to get toilet paper of all things, it was out of you could never find it was out of stock. It's because the demand went totally haywire on it, and people bought way more than they normally would. And the producers of toilet paper, and believe it or not, they're very efficient producers. They, they operate at capacity, so it's not like they can just turn up the machine higher and turn out a bunch more toilet paper. They're already making it at a very high capacity. So anyway, just it's amazing how tight inventory management's become, and the reasons for it are pretty self-explanatory. Um, and then we're going to understand that the less liquid that an asset is, the more important it is that we get a higher rate of return. And that's a theme that'll repeat itself several times throughout the class. Okay, so that was chapter 7. So the other way of looking at this is that in the short term, we also have needs for financing, and all companies have that need. So trade credit from suppliers is normally the most available form of short-term financing. In other words, if somebody you buy something from somebody and you don't actually have to pay them for 30 days or something like that, that trade credit and the discounts that you get for paying a bill within a certain period of time are essentially short-term financing. So you can take a look at that. Recall that bank loans are are usually short-term and should be paid off from the funds from normal operations of the firm. You don't want to get in a position where you're borrowing to pay off short-term bank loans. I can recall having things that were called revolving lines of credit, for example. So it implies very short term. You borrow a little bit of money here and there just to make sure your working capital is sufficient, and you pay it back as soon as you possibly can, just from the normal operations of the company. So there's a thing called commercial paper, which is a huge source of short-term financing for typically very large organizations, and it's a very big market. Commercial paper is an important one. You'll talk about using accounts receivable and inventory as collateral for a loan in the short term. So the firm you may be able to borrow larger amounts. These things have become very important as your business grows, and you need to buy in more inventory, more of what you need, and to do that, you're going to need some kind of short-term loan. So you do that typically through using your inventory or accounts receivable as collateral, your current assets. And then you're going to cover the topic of hedging. Okay, so that covers what we're going to cover up to the point of the test. You still have chapter 9 to do, which gets us into a new area, so we'll briefly review that. But in chapter 9, starts our next section, which is we start talking about capital budgeting, which is taking a longer term view towards how to finance an organization. So we got to start with a very important concept called the time value of money. You're going to take a good look at that in chapter 9. Probably one of the most basic key things that you need to really walk away with a good understanding of from your first finance class. So your objectives are going to be explain the time value of money, how a dollar received today is worth more than a dollar received in the future. So when then we think about what the future value is of an investment or or some type of form of raising capital. The future value of it is based on the number of periods over which the funds are to be compounded at a given interest rate. As you well know, if you borrow money to pay for, let's say, an automobile, you're going to pay a lot more than the purchase price of the car. Ultimately, it's going to cost you more than that. So that's what the future value takes in consideration. Present value is based on the current value of the funds to be received in the future. So that's a different type of calculation. You're going to take a look at yield on investment, rate of return, annuity due, payments required, all the things that go into that. And then you're going to talk about compounding or discounting, and it can take place on regular basis. A lot of times we talk about it annually, but sometimes it's daily, sometimes it's semi-annually. It really depends and has a pretty big effect on how much the money costs, so the capital costs. So basic stuff in there, but very important to know and very foundational for the rest of this section of the book, of the class, I should say. Okay, so that's it. So I wish you the best luck on the test. If you have any questions beforehand, don't hesitate to reach out. And I'll put out another announcement in a video a little bit more, explaining more about what's on the test and what it is early in the week. Okay, that's it. Good luck this week. Thank you.